You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome in to Options Playbook Radio. I'm Brian Overby, the author of the Options Playbook and your host for about the next 15 minutes here on Options Playbook Radio. Today's date is Monday, November 10th. The markets are not open, but the government might be. Over the weekend, we had the Senate pass a funding bill that is going off to the House, and if you look at the prediction markets, they're saying there's about an 85% chance that the House will actually pass this bill, and we will have a new budget. With that said, I still always like to emphasize that there's a 15% chance that it won't happen, so just keep that in mind. But the markets are really liking this news, which I find very interesting because when the government shut down, the markets basically did nothing. And right now, the markets are indicating in the SPX that they're going to be up about 1%. I'm guessing that the market's going to open right around 6,800 in the SPX. And I want to put together a 0 DTE trade in the SPX, an open wing butterfly that will last for the 1 day, for Monday. And then I'm going to also look at a longer term one that will expire on Friday. Who knows when you're listening to Options Playbook Radio, but if you do have that opportunity early in the morning to address the trades, you might want to take a peek at them. Right now we have the VIX index going into the weekend right around the 19% level, so high implied volatility means that butterflies are cheaper. Whenever we're looking at a 0 DTE butterfly in general, we're looking to sell the most time premium as possible. So we're going to sell the most at the money option contract. Now, I don't know exactly where that at the money is going to be, but I do have a good feel for where the market might be. First of all, I've done a lot of 0 DTE butterflies, and I'm going to give just some indications based off of where I think the market's going to open. I'm pretty sure it's going to open fairly close to the 6,800 level. And I'm going to use that nice round number just to make things simple. So if I'm looking to put on a trade like this, just adjust your strikes accordingly. Look at where the most at the money is at, and that's where you want to sell it. And that's what option contract that you want to capture as much time premium as possible. And that's what makes 0 DTE option trading interesting, especially in a large index like the S&P 500 index. All right, so if I look at it in at the money open wing butterfly, when I'm talking to the retail public, I do want to try to bring down the cost. Now, nothing out here is meant to be a recommendation. Just want to talk about a setup and my approach to it. But I don't know who you are out there, so the 0 DTE options are very speculative. So there's my disclaimer. All right, so with that said, if I'm looking at the market opening at 6,800 on Monday, November 10th, what I would look to do is sell 2 of the 6,800 strike calls, go down 15 points, and I'm going to buy the 6,785 strike calls. And then I'm going to go up 10 points from our center strike and buy a 6,810 strike call. So this is called an open wing butterfly. In my mind, there isn't necessarily a name for the strategy. I'm actually going to add it to the next version of my book, and I'm going to call it an open wing butterfly because to me that makes sense. We're going to open up the short spread. We're going to stop, well, I should say it this way. We're going to stop short on the short spread, which will make us profitable if the marketplace blows through our strikes. Now, I'm anticipating that this will trade somewhere around $4. That's normally where they would trade at, and I want to do this right on the open because the market is showing to be really strong at this point in time. So if it's 425, if it's 380, I'm still looking to do the trade because it's all about the time decay, and it's all about trying to capture that at the money implied volatility. Now, if I look at the options and we're going 15 points wide on our long spread, which means we're buying the 6,785 strike call. We're selling 2 of the 6,800 strike calls. Okay, so our long spread is 6,785 to 6,800. That's 15 points. Our short spread is only 10 points, from 6,800 to 6,810. That means that if this market goes above our 68.10 strike and we paid $4 for it, we could make $5 on the trade. The long spread is 15, the short spread is 10. That means if we're above that strike, it's going to trade for 5. We pay 4 for it. I'm not quite sure exactly where it would be at because the markets aren't open yet, but then we would be up $1 on that trade. 0 DTE trade, put it on very early in the morning, look to get out about 1 o'clock. From 1 o'clock on, Delta and Gamma take over. Theta is no longer in control of that position. I mean, ultimately, price is the most important factor. So if the market does go against you early, it's still going to hurt. But you still have so much time premium in the at-the-money option contract. Like in general right now, the at-the-money option contract with a 0 DTE option is trading for $11. And that needs to go to 0. That has to go to 0 by the end of the day. So that's a lot of time premium. And when you're looking at SPX options or any high value index, that time premium is sticky. It stays around until about noon Eastern time. And then in the last 4 hours, you really see the time decay kick in. So that time value protects you in the first half of the day. And if the market is going with you, well, then you just get out. And you don't try to hit a home run on these trades. You're trying to make a few dollars. And you're trying to manage your risk on the downside. Now, if it gets outside of your strikes and it's getting past the noon hour, it's going to start hurting. So at 1 o'clock, if I'm not up on the trade, I'm going to close it. By 2 o'clock, I definitely want to get out. But bottom line is, if it's 1 o'clock and I'm profitable and I'm not quite as profitable as I want and it's staying within my strikes, well, I might ride it a little bit longer. But after 2 o'clock on the trades, I'm not looking to hit a home run. And that's, once again, where the real, on 0 DTE options, that's where the risk really kicks in. Okay, so I'm going to give you a second trade because I don't know when you're listening to OPR. But I do want to stay bullish, especially if the prediction markets are correct in saying that by Wednesday the government might be opened up. Once again, that's just a prediction market. It's, inflows of cash coming in from novices trying to figure out what may or may not happen with the U.S. government. So it's the only thing we really have to go off of, so I'm going to ride it. If the markets are indicating up at least 1% at this point in time, as a matter of fact, the NASDAQ is actually indicating up about 1.5% in the futures market. I'm going to look at a Friday expiration, and I'm going to use the exact same strikes. I might go a little bit wider personally. If I was looking at a Friday expiration, instead of 15 points wide on our long spread, might look to do 20. But I want to compare apples to apples, all right? So this is interesting, just to note how time decay works in the S&P 500 index. But we're going to use the same strikes. We're going to use, and I'm not going to read it as the 6,000 level. I'm just going to read the numbers. All right, so we're looking to go out to the November 21st expiration, which is this Friday. We're going to buy the 6785 call, sell 2 of the 6800 calls, and buy 1 of the 6810 call. So, exact same strikes, different expiration, going out till Friday. We can get this trade off for cheaper. You would expect it to be cheaper, but it's not a heck of a lot cheaper. According to where the markets are at right now, basing it off the most at-the-money option contracts, that option would be trading or that open wing longer term butterfly would be trading for around $3.40 at the midpoint. So there's not a huge difference in cost, but there's a lot of difference in time and a lot of different dynamics of this. In other words, if the market does go against you, it's not going to hurt as bad. Why? Because you have time premium. If you are wrong on a butterfly, you want time premium. Time premium helps you when you are wrong, but if you are correct, you don't want time premium. So it's going to be harder for this trade to max out. And if you're leaning into the weekly option contract, you really want to be bullish. More so bullish than neutral, like you are on the 0 DTE, the November 10th expiration. So we're going to do a 1x2x1. We're going to buy the 67.85, sell 2 of the 68.00, and buy 1 of the 68.10. $3.40 based off of an guesstimate that the market might open around 6,800, and that's what the futures are kind of indicating, up about 1%. And then obviously on both of these trades, we're okay if the market goes to the upside. Our risk only kicks in if it goes to the downside, and that would be anywhere below our 6,785 strike. Maximum we can lose on the trade is the net debit that we paid for the butterfly. So either, I'm guessing, around $4 on the 0 DTE, the Friday expiration around $3.40 approximately on that trade. And if you're putting the trade on, the maximum upside is $15. Well, the maximum that it could trade for is $15. Never looking to try to hit a home run. One of the things I do love about the SPX is that it's a cash settled index. So you don't have to worry about assignment. If there's cash belongs in your account based off of where the index value is compared to your options, cash shows up in your account. If cash doesn't belong in your account based off of where the strikes are relative to the index, cash doesn't show up in your account. There's no trading of all 500 stocks in the S&P 500 index. It's one of the things that I love about the good old SPX index and a lot of other cash settled index. That's it for this edition of Options Playbook Radio. My name is Brian Overby. Please check out optionsplaybook.com. That's my website, and you can always buy my book on Amazon. And until next time, may all the options that you buy finish into money and all the ones that you sell finish out. Thanks for tuning in.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.